We grow up believing the digital numbers in our bank accounts represent our actual wealth. The truth is that 500 rupee note in your pocket has zero intrinsic value. It's simply a shared societal belief, a medium of exchange designed to help us trade our time and effort. Earning a massive salary doesn't protect you from poverty. Take two guys. We'll call them Kaju and Motobai. Kaju makes a high salary but knows absolutely nothing about the rules of money. Motobai earns an average wage, but he is financially literate. If Kaju is the one bringing in more cash every month, why is his life defined by constant stress and zero options, while Motobai is rapidly building total freedom? The answer requires us to define the difference between income and wealth. Income is a flow. It's the water pouring out of a tap. Wealth is what you own. It's the water that actually collects in the bucket. True wealth is not defined by the size of your monthly paycheck. True wealth is your ability to build a collection of assets that continue to generate value for you while you sleep. Kaju suffers from a high-income, low-retention problem. Modern technology makes spending frictionless. A quick UPI scan removes the psychological pain of handing over physical cash, causing his bucket to drain through dozens of invisible daily leaks. Motobai avoids this by adopting the 50-30-20 rule. He doesn't view budgeting as a restriction on his life. He views it as a GPS system that gives his money clear direction. This chart shows his exact allocation. Half of his income goes to strict needs, like rent and groceries. 30% is allocated to wants, ensuring he doesn't feel suffocated. The final 20% is locked in as savings. The sequence here is critical. Motobai makes saving his very first expense of the month. Kaju waits until the end of the month to save whatever is locked over, which mathematically guarantees he keeps nothing. Earning a high income without a disciplined cash flow system simply makes you a highly paid slave to your own lifestyle. No matter how tightly you budget, life will eventually stress test your system with a sudden layoff, a car crash, or a medical emergency. Kaju skipped building a safety net because he wanted quick returns in crypto. When a massive uninsured hospital bill hits him, his entire net worth drops to zero overnight. Motobai survives because he utilizes risk pooling. He pays a tiny monthly premium for term and health insurance, effectively transferring his catastrophic financial risks onto a massive institutional pool of millions of people. Emergency funds and insurance policies will not make you rich. They act as the essential structural moats that stop you from suddenly becoming poor. Even when Kaju does manage to save, he incorrectly views his bank as a secure vault. In reality, banks are middlemen. They take Kaju's idle deposits, pay him a tiny fraction in interest, and lend that exact same money out at a steep markup. The cost of this borrowed money is dictated by the Reserve Bank of India. The RBI uses a master control switch called the repo rate to determine exactly how expensive debt becomes across the entire economy. When global supply chain shocks or geopolitical conflicts cause inflation, the central bank is forced to hike these rates. Suddenly, Kaju's bad debt, the EMIs he took out for a new iPhone, becomes crushingly expensive to carry. Motobai, however, uses debt to his advantage. He utilizes good debt, leveraging other people's money to acquire assets that generate their own cash flow. For a masterclass in how the wealthy execute this, look at Shah Rukh Khan's 2001 purchase of his residence, Manat. SRK put down a small fraction of the purchase price from his own pocket and took out a massive bank loan for the rest. He controlled the asset, allowing the property's immense appreciation to completely outpace the cost of the debt over 2 decades. Debt is a strictly neutral tool. It is a lethal trap for consumers buying electronics on credit and a powerful accelerator for investors acquiring cash-flowing assets. There is one unforgiving variable left in this A/B test: time, and its mathematical relationship to compounding returns. This chart shows the scenario. Motobai invests $5,000 monthly at age 25. Kaju waits a decade, starting at 35, investing 3 times as much. By age 60, Motobai reaches 3.2 crore, outpacing Kaju's 1.8 crore, despite Kaju injecting significantly more principal capital. Warren Buffett summed up this psychological hurdle perfectly. Everyone wants to get rich, but nobody wants to do it slowly. Without time, compounding is incredibly weak. With time, it makes an investor mathematically unstoppable. The ultimate objective of this financial framework is not hoarding cash to look wealthy. The entire machine is built to help you cross one specific threshold: retirement. Forget the outdated notion that retirement means turning 60 and becoming physically incapable of going to the office. True financial independence has a strict mathematical definition. It is the exact moment the passive income generated by your assets exceeds your monthly living expenses. The modern economy, with its frictionless cashless societies, easy credit, and persistent inflation, is intentionally designed to keep the financially illiterate working until they die. Budgeting is the map. Saving is the vehicle. Investing is the fuel. Freedom is the destination. You either engineer your own system today, or you will be forced to work forever for someone who did.